Good day, viewers. Welcome to our SA listed property dashboard. This is the first one for 2024. I am Binette van Wyk, COO of Catalyst Fund Managers, and this morning I'm joined by Ofense Tlavi, an investment analyst of our SA listed property long-only portfolios. Ofense, I think we were all very surprised that 2023 delivered SA listed property as the best performing SA asset class. That nicely catapulted into 2024 where we've seen SA listed property still doing very well. I want you to maybe spend some time in unpacking what were the key drivers of this performance, and then we've received this question many times from investors. Given this outperformance compared to other asset classes, do you think there's further potential for more upside?
Thanks, B. So the sector's recovery has continued due to slowing inflation, more stable energy generation, a favorable election outcome, and a re-rate of local bonds. Following the strong performance, the question of whether there's further upside depends on a number of things. The first one is where the 10-year government bond yield will settle after the interest rate cutting cycle begins. It also depends on whether we see foreign capital flowing back into South Africa due to expected reforms. And of course, if we continue to see an improvement in operational performance of the SA listed property companies as evidenced in the latest results. We believe that a decrease in interest rates will positively impact sentiment, but the impact on earnings will be more gradual as a large percentage of debt costs are fixed and it will take some time for the hedges to roll off.
Friends, if we look at the All Property Index, or the ALPI as we call it, right? And if we look at it on a see-through basis, only roughly 50% is really SA, right? So did the majority of this outperformance come from our SA-centric or the offshore-centric counters within the ALPI?
So the SA-focused companies outperformed their offshore counterparts, and this was supported by the formation of the Government of National Unity, which is a significant event that led to the strengthening of the rand and an increased appetite for risk assets.
If we look at SA listed property, we really only have three major sectors, right? We've got retail, office, and then industrial. Can you maybe spend some time to unpack the operational performance and the outlook of each of these sectors?
So operational performance is improving despite rising utility and municipal costs and deteriorating infrastructure. Net operating incomes are up across the listed property companies. If we look first at retail fundamentals are strong with rising occupancies and positive rental reversions, which is driving revenue growth. Trading density is up by 6.2% despite higher inflation and interest costs. The retailer's cost of occupancy is at the healthiest level that we've seen in over 10 years as sales have outpaced rental growth, which provides landlords with some bargaining power to increase rentals going forward. The CEE retail market is performing well with low vacancies and rising rentals. Sales have surpassed the pre-pandemic levels, supported by wage increases. In terms of the office market, we've seen a marginal improvement there, with vacancies coming down to 14%. Rentals have been negative since 2019 as landlords have had to give significant incentives to tenants to attract them in an oversupplied market. However, if we look at the prime office market, we've seen a significant improvement there, particularly in Cape Town, where vacancies are the lowest they've been since 2009, driven by immigration and a growing business process of outsourcing market. Industrial remains a top performing sector with the lowest vacancies and highest total return, driven by the demand for logistics and e-commerce. A reduction in load shedding and structural reforms could spur recovery in the manufacturing segment. However, focus in the short term remains on distribution and logistics centers for investments.
Things sound quite positive to me, hey?
I'm always the positive, the ever bull, as they call me.
If we now look at Spain and we look at Portugal, right, we know it's this ever-evolving and super dynamic landscape, and it's really been seeing a lot of attention from investors. Viewers, as part of our process, it's super important for our investment professionals to go and actually view the physical assets, so the physical bricks and mortar, And you had the opportunity, right, recently to go do exactly that. So am I right in saying you viewed 4 retail Iberian assets?
Yes.
Maybe you can share with us what were some of the key takeaways and some of the key trends that you were seeing on this tour.
So the tour was great, and it provided us with insights on the Iberian retail market, what makes it attractive, and what is contributing to the growth. This market is characterized by strong GDP growth ahead of its Western Europe peers, above inflation wage growth, and robust post-COVID retail recovery. The area's warm temperatures, high quality of life, and relatively low cost of living have contributed to an increase in tourism and population growth. Sales are strong, and as evidenced by Lighthouse's malls in particular, sales have increased by 7 to 12% per annum for the first quarter of 2024. Malls drive significant foot traffic through a mix of international and local brands and strategically located restaurants. The culture of frequent dining out further enhances the attractiveness of malls as centers for shopping and for social activities. Despite the growth of online shopping, physical retail remains dominant, with an omni-channel approach being the most ideal.
I think I know where I'm going next, hey? So, Artie, if we look at SA listed property as a whole and we look historically at the total return profile, we know that roughly 2/3 of the total return profile has mostly come from the yield play compared to capital growth. When we talk to investors and they are comparing SA listed property to local bonds, their big question is why listed property? And they want to know especially why when we're focusing on the growth. Where is that growth going to come from? Can you maybe just share your views with us?
So growth in 2024 will remain uneven, with many large emerging markets staging a recovery. If we look on the local front, optimism on the continuation or acceleration of structural reforms, together with lower levels of load shedding, which is positively impacting sectors such as mining, manufacturing, trade, and consumer spend, could lead to upgrades in GDP growth projections. In Central Eastern Europe, the macroeconomic situation there is steadily improving, and this is positively influencing the closely linked real estate market. Poland and Romania, in particular, are expected to have strong recoveries in 2024 and 2025 due to private and EU-funded investments, job creation, and robust wage growth.
Well, Fencer, we know that the last 2.5 years have really been driven by capital markets, where inflation is sitting and where interest rates are sitting. And given that listed property is a levered asset class, the question on everyone's mind is like, when are the interest rate cuts going to come, right? Are there going to be cuts? When are they going to come? And what is the quantum going to be? And then obviously what the impact will be on the SA listed property sector. Maybe you can share your latest views with us.
So higher funding costs have been the main detractor to listed property earnings since the start of the SARB hiking cycle, which began in November 2021 and saw interest rates increase by 475 basis points, where the prime rate currently sits at 11.75%. On average, the sector has around 75% of their debt costs fixed for an average tenure of 2 years. And given this, we expect debt costs to peak in 2025, after which the hedges will roll off and we'll see an improvement in interest cover ratios and balance sheet health. Research conducted by Standard Bank Group Securities suggests that around a 25 basis point reduction in interest rates should increase earnings, distributable earnings, by around 2% for the sector.
And then I have to ask, last but not least, what is your outlook for the SA listed property sector?
So, as much as we like to remain positive, in the short term, the SA listed real estate landscape remains challenging, but pockets of opportunity have emerged. The reduction in load shedding will provide some relief in terms of diesel and generator maintenance costs. The retail sector, which was heavily impacted by the rolling blackouts, will be the one to benefit the most from more stable energy generation, together with the implementation of the two-part retirement system. A prospect of a business-friendly South African government could bolster the economy and boost earnings. We will continue to assess risks and seek out opportunities that this market provides with the aim of generating superior returns for our clients.
Fense, thank you for your time and for sharing your valuable insights with us. We will definitely be looking for these pockets of opportunities. Viewers, if you'd like to learn more about the SA listed property sector, please refer to our full SA listed property dashboard. Or alternatively, please reach out to me as per the contact details below. Thank you for your time and goodbye.